So, what the heck's going to happen to San Francisco and Silicon Valley as we know it? Is it over? And is there too much venture capital? What's going on with these mega rounds and IPOs? Well, those are just a few of the things we talked about last week at Web Summit with my friend and legendary investor Elad Gil and Bloomberg tech reporter Katie Roof. Let's get into it.
2020 has been an unusual year. It's something that VCs were talking about for years, is that remote work was going to be a trend, and it finally happened this year. So is remote work here to stay?
I actually really think that hybrid model is probably here for big cos, but small companies, I think, will still get a lot of benefit from being in one place. I mean, my cynical view is that larger orgs post product market fit are really about slicing up the pie. So, one of the things that people were really worried about when it came to remote work was how are people going to get promoted, which is a very important thing in bigger organizations. When you're actually making the pie pre-product market fit, you've got to move way faster than everyone else. You're going to need every advantage you can get. The earliest possible stage startup will still see a lot of benefit from being in one place, in one room, a one pizza team, as Jeff Bezos would say. And I think that bodes really well for San Francisco, hopefully.
Yeah, I agree with Gary on that. I think remote work was dramatically overstated before COVID. And if you looked at the number of companies that had scaled to many hundreds of employees as remote-only companies, there was only, I think, 3 or 4 of them. It was GitLab, it was Zapier, it was Automatic. There's very few companies that ever made that transition. And now, because of COVID, obviously everybody's forced to do it. But I've been hearing increasingly from companies quite a bit of unhappiness in terms of the way that they onboard employees, the ways that people have to interact with each other. And I think that if a company is large and self-sustaining and it has a lot of momentum, it's easier to go remote. If you're at the earlier stages, you're just figuring out the very first aspects of the product. There's a lot of benefits to having everybody together. And so I think for larger companies, probably what we'll see is more flexibility that didn't exist before in terms of remote. So for example, Facebook and Twitter and others have said that they're willing to have a large chunk to most of their employee base working remote, but in many cases, that means synchronized days. So every Wednesday, Friday, people can work from home, but the rest of the week, they're going to be in the office, or there's other sort of hybrid schemes that may emerge. But I do think that, we're in a moment right now where everybody's stuck at home due to COVID. There's no pottery class at 5 o'clock. There's no going to the gym. There's no meeting friends for drinks. And so I think a lot of companies that I'm involved with, at least, are seeing their employee base be incredibly productive as remote workers. But I think it's because everybody's stuck at home and all they can do is work. And so I think that once COVID has passed, we'll see some companies continue to do it, but I think many will either snap back or, to Gary's point, be a bit more of a hybrid model.
So what does this mean for VC dollars? Are they still going to be funding companies headquartered in San Francisco, or is it not going to matter anymore when we look at 2021?
Yeah, I mean, I guess on my side, I think there's incredible amount of diversity out there, and it's really sort of one global software market at this point. In this year, for the first time, we did 2 investments in Europe, and those are pure software companies. So they, don't have a link to just Europe. They sell to companies worldwide in e-commerce and other spaces that are all connected. It's all the same market, and we've been doing that for crypto for some time. We were first investors in Coinbase, and that taught us that crypto is software eating money, and that software is totally global. I think that trend will continue. What I think might happen is that the Bay Area becomes a second renaissance. So rents are down 30%. Tech workers, when we say tech workers, we generally actually mean Facebook workers, Google workers, sort of like the tech giants. And those workers are leaving. They're taking their $500,000 a year salaries with them. The scrappy founder that raises $1 million and pays themselves, $50,000 a year, me from 15, 20 years ago, I guess, they can come to San Francisco again, and they'll find other people who are like-minded, and there will, be magic that happens that way. But at the same time, because the internet culture of startups has gone global, things like YouTube is now, I realize, a thing that is teaching people how to start businesses everywhere. Web Summit, this event right now, there are people in this audience right now that are thinking about starting a company, and that's why you're watching us right now. And I want to tell you, the water is fine. So San Francisco is still a great place to come to. I encourage you to come meet us here. But it's also happening in your local, in your closest, metropolitan area too.
I think there's two things that are kind of at odds at each other that are sort of going to drive where startups will exist in the future. I think on the one hand, startup markets are bigger than they've ever been, and online markets are bigger. So if you look at time spent online, number of people participating in the internet, penetration of Wi-Fi and access at work, et cetera, internet markets are literally 10 times bigger than they were 10 years ago, maybe 20 times bigger. And that means you see companies that used to have 10 or $20 million in revenue, that would be a niche company that wouldn't matter that much, end up with hundreds of millions of dollars and therefore be $1 billion plus company, or what people call a unicorn. And so that's driven the behavior where we've seen many more unicorns distributed globally in terms of lots of cities will have one. On the other hand, if you actually ask where is all the tech market cap aggregating, at least over the last 15 months, and again, COVID may derail that, of the 187 unicorns that have been created in the last 15 months, about half of them were in the US and about a quarter of them were in Silicon Valley, which is consistent with historical trends for Silicon Valley. And so I do think that we're going to continue to have a cluster in the Bay Area. We'll continue to have a cluster in Beijing. You'll continue to have a cluster in London, et cetera. And then you'll see this sort of fine distribution of fewer but still great companies sort of distributed around the world. It's kind of funny because if you were in any other industry that can do everything remote and digitally, finance is a great example. If you want to set up a hedge fund, you could raise money from anywhere. You could hire people anywhere. You could do trading from anywhere. But everybody sets up their hedge funds in a small number of cities. And the same thing is true for Hollywood and movie making, right? You can digitally edit a film, you can shoot anywhere, you can write a script from anywhere. But the reality is if you told somebody even today, I want to go into movies, where should I go? People would say you should go to Hollywood. And that's because these industry clusters have very strong network effects that accelerate companies and people working in those industries. And so I don't think that sort of basic human behavior goes away after COVID. Maybe Silicon Valley loses a piece of the people who normally would be here because they set up shop during COVID elsewhere. But I do think, there are a small handful of places where people will go to start things. And then you'll have this fine distribution of startups everywhere else.
Elad, you mentioned Beijing, and I have to ask because in the past few years, there hasn't been as much cross-border investing from US investing into China and a little bit vice versa. Like, do you think that's going to change, or do you think that those are going to be separate ecosystems going forward?
Interwoven ecosystems where, to your point, there are large local brands in China that are the predominant early stage investors. But if you look at it, some of the biggest investors in China are things like Sequoia Capital, which is headquartered here largely. There's international firms like Coatue or DST or others who've for a long time been doing, let me invest in any great technology company anywhere. Tiger Global has been doing that for a long time. So I think in every market, we're going to have the local players who are going to be dominating or participating heavily in certain stages. And then you're going to have either people who sort of set up new offices locally, Sequoia or Matrix or other in China would be an example, or these global firms that are effectively just trying to index tech at the later stages globally.
So there's been a lot of capital raised in the United States in the last few years, actually a record amount there. And it's not just with the big venture funds. We're seeing small venture firms springing up everywhere. What do you think? Do you think there's too much capital being raised, or do you think that it's the right amount?
Oh man, I think we're just getting started, honestly. On the IPO side, in 2016, there were about $4 billion worth of VC-backed IPO proceeds, and 2019 it was 28 billion. So it's ramping, it's continuing, and what's interesting is it's a 6-year gap. So if you look at venture funding, 2011, 2010, that was about $50 billion in venture capital for instance, and that scaled up to 77. So the exits are actually getting bigger. In 2016 there were 42, in 2019 I believe there were 80. So I think the numbers are going up, the size of the exits are going up, and I actually think that the public markets are leading the private markets at this point, because the public markets are starting to say, if you're an incumbent business and you don't have software or technology as a key part of your business, the public markets are starting to say, we're worried that you might not have future cash flows. I think it's probably overblown. I think Mr. Market is getting a little ahead of itself. On the other hand, there are clear market power dynamics to the top 5 tech companies. When Google first started, we said it was a search engine. How is it ever going to make money? In 2020, it's very easy for us to say the reverse, which is, how is anyone else going to make money other than Google? Their second price auction is going to suck all the value out of the economic system.
It's interesting because if you look at every decade, at interviews of venture capitalists in that decade, they're always complaining about how there's too much money coming into the system and it It's not like the good old days that happened in the 80s and 90s and 2000s and 2010s. And so it's a very consistent trend that every generation complains about how now there's too much money in the system. But to Gary's point, if you look at valuations, if you do believe that online markets are 10x bigger, one could even argue that maybe there's too little capital.
Yeah. I mean, I think one of the most investable things I'm most excited about right now is actually this sort of anti-Amazon strategy. You know, we funded Instacart very, very early. Ex-Amazon engineer Apoorva Mehta had just this idea about, and he was a supply chain engineer at Amazon. And what's funny is, you know, this past year, Jeff Bezos used Apoorva's name and Instacart's name in his annual letter to try to slip the grip of, you know, the congressional hearings about antitrust. So I think that this is a very real, if the tech giants are the empire, well, we really like to fund the Jedis. I think that that's something that is actually really fun for Elad and I.
So it sounds like you're not too concerned about valuations getting too high because the stock market has been pretty strong. But what do you think? Is that going to continue? Are we going to still see this many IPOs? I mean, the last few months of 2020, we saw a record amount of IPOs, particularly big IPOs. Is that going to continue into 2021?
I think there's two separable things. First off, I think on the valuation side, I think the best companies always look expensive at the time and cheap in hindsight. So when Facebook was funded at a $500 million valuation, everybody said that was insane. And then at $1 billion, oh my gosh, who could fund them at $1 billion? And then Yuri Milner and DST came in, and I think they bought into Facebook at somewhere between 5 and 7 billion. And people said they're nuts. You know, how could Facebook be worth $5 billion? And now it's, you know, a $400 billion or whatever it is company. The flip side of it is most companies are not Facebook. And so I think with valuation, you end up with sort of two humps. You have the really great companies that are always overpriced at the time. And then 6 months later, you're like, my gosh, that was very inexpensive. And then there's all the other companies, many of which really don't deserve the market caps they have. So I do think that probably half of the so-called unicorns or billion-dollar-plus companies are dramatically overvalued. And then a subset of them are probably dramatically undervalued. On the public market side, I mean, there's lots of great companies that are still private today that have expressed intention of staying private for some time. Stripe would be a great example. There's a variety of others, Instacart, et cetera. So I think there's some great companies out there that are still private, aren't going public this year. I think in general, there's so much of different markets, to Gary's point, being consumed by tech, that it's a big wave.
So which ones are overvalued?
That's the question. It's tough to know. You'd have to look at their financials. And that's part of the problem, right? These private unicorns don't open their books. And so it's sort of the worst possible scenario for founders, for, I mean, early stage people like me and Elad. I mean, like that's actually a problem for us, that it's private valuations, and Mr. Market has its flaws, but Mr. Market has so many players that it's often far smarter than you know, a small oligopoly of capital allocators, which is very interesting. And we're very much in the grips of that. I found this amazing video that I'll post on my YouTube channel on, it was Arrington in, I think, 2009, interviewing Yuri Milner at Davos. And he, you know, point blank was asked, like, why did you do Facebook? Yuri says, we did an analysis of all the IPOs for the, you know, the 10 years preceding, and every single tech IPO at that time in 2009 had a 10 to 20x left in it. It's funny to hear that, and you know, hindsight is obviously 2020, but it was prescient, and it sort of explains the whole private bubble that I think we bounced off of with SoftBank Vision. You know, that was a very extreme version of people are desperate for yield. You know, sovereign wealth are desperate for yield. And this is a very pure asset class for yield. There's at the same time negative interest rates. What does that mean? Like, people will pay you to hold on to that cash because people are so lacking in ideas. And that's very strange for me, because we get to meet founders every single day who like show us some crazy problem. And once or twice every single year, we find a company that turns into a unicorn. So that, I mean, what kind of miracle is that? I'm very excited about what we get to do and what tech is able to do, actually.
So between all the IPOs and SPACs happening this year, do you think these are going to spawn new startups? And what sectors do you think these startups will be in? What sectors are you excited about to invest in?
Inside companies, you almost see these generational wave of employees, and often people will leave at different sort of marks in the company's lifetime. And so often you see a wave somewhere between 6 or 7 years into a company, and then you see a second wave around 8 to 10 years. And so you saw that at Google, you saw that at Facebook, you see this pretty consistently. So for example, I feel in the context of Silicon Valley, a lot of the core networks right now are things like, you know, there's a lot of people from Stripe starting companies. There's a lot of people from Opendoor starting companies. And so in some cases, it's the pre-IPO companies where you see the activity. In some cases, a company has been public for a long time and people are leaving to start things. So Google and Facebook and Square all have these strong alumni networks as well. And that's just a subset of the list, but those are examples of, I think, some of the core networks where people are starting companies out of.
Yeah. I think it's really hard to ask a VC what's hot, because if you go by what we say is hot, it's like it was actually hot and investable like 9 or 12 months ago, probably when we first met companies doing that. So it's really tricky. I mean, the more subtle and really interesting thing that I think happens for unicorns and companies that become very, very valuable is they actually just start off as toys, and they start off very weird. I mean, when Brian Armstrong quit Airbnb, to Elad's point, it is often the networks that sort of make this happen. He read the Satoshi Nakamoto white paper, and nobody believed that crypto was going to be a thing then, but he believed, and then he quit a job that was a guaranteed, Airbnb had just become $1 billion startup. And so that got my attention. I mean, that was very, very powerful. I think it goes back to that. It's like, what is the fringe? What is the thing? What is the hobby? What is the thing that consumes people, especially builders, especially early engineers and designers and product people? And that's what ends up teaching us what the next unicorns really will be.
Well, thank you, and back to Lisbon.